Peter Lynch is one of the most successful investors of all time, and his famous quote, "Never get out of the market," has been heard by countless investors and traders. This quote has become famous for its simplicity and wisdom. But what exactly does it mean? In this video, we will explore the meaning behind Peter Lynch's famous quote and explain how investors and traders can use it to their advantage. What did Peter Lynch mean by his famous "never get out of the market" quote? Peter Lynch, a renowned investor and former manager of the Fidelity Magellan Fund, once famously said, "Far more money has been lost by investors trying to anticipate corrections than lost to the corrections themselves." This statement forms the basis of his famous "never get out of the market" quote. Lynch's point was that attempting to time the market and pull out when it looks like it might dip can often lead to missed opportunities and potentially larger losses in the long run. He believed that instead of trying to time the market, investors should focus on buying and holding a diversified portfolio of quality companies. Lynch's advice is based on his long-term perspective on investing. He believes that in the short term, the stock market can be volatile and unpredictable, but over the long run, it has consistently shown to provide higher returns than other asset classes, like bonds or cash. Therefore, by staying invested in the market, investors can benefit from these long-term gains. Additionally, by investing in a diversified portfolio of companies, investors can minimize their exposure to the risks of individual company performance. Overall, Lynch's famous quote emphasizes the importance of taking a long-term perspective on investing and avoiding the temptation to try and time the market. By staying invested and holding a diversified portfolio, investors can position themselves to benefit from the long-term growth potential of the stock market. However, while Lynch's advice is generally sound, there may be some exceptions to the rule. For example, if an investor is nearing retirement age and has a higher risk tolerance, it may be prudent to reduce their exposure to equities in favor of less volatile assets. Additionally, if an investor has a strong conviction that a market correction is imminent, they may choose to adjust their portfolio accordingly. Ultimately, following Lynch's advice requires discipline and a commitment to a long-term investment strategy. By maintaining a diversified portfolio of quality companies and avoiding the temptation to try and time the market, investors can position themselves for success in the stock market. Why is this sage advice for investors? Peter Lynch's "never get out of the market" quote is considered sage advice for investors because it emphasizes the importance of having a long-term perspective when investing in the stock market. The stock market has historically trended upwards over the long run, despite short-term fluctuations, so staying invested for the long term can increase the likelihood of realizing gains. Furthermore, attempting to time the market by getting in and out at the right time can be a risky strategy. It's difficult to predict the market's movements with precision, and there is always the possibility of missing out on gains if an investor is out of the market when the market experiences a surge. By never getting out of the market, investors can take advantage of compounding returns over time. Even if there are occasional market downturns, holding on to stocks can allow for the opportunity to recover losses and ultimately realize gains. It's important to note that this strategy works best when investing in a diversified portfolio of stocks, rather than trying to pick individual stocks that may underperform. Overall, Peter Lynch's "never get out of the market" quote serves as a reminder to investors that staying invested for the long term is a key ingredient to achieving success in the stock market. What are some exceptions to this rule? While Peter Lynch's advice to never get out of the market is generally sound, there are some exceptions to the rule that investors should be aware of. One such exception is if an individual company in which you have invested experiences significant financial difficulties or scandals. In such a scenario, it may be necessary to sell the stock to limit losses. Another exception is if you need the money for a large purchase or expense, such as a home or medical bills. In this case, it may be wise to liquidate some of your investments, including those in the market. It is also important to note that while staying invested in the market over the long term can be beneficial, investors should still regularly assess and rebalance their portfolios. This may involve selling some investments and buying others to maintain a diversified portfolio that matches your risk tolerance and investment goals. Furthermore, there are different types of markets, such as bear and bull markets, which can impact investment strategies. During a bear market, when stocks are declining, it may be tempting to sell investments. However, historically, the stock market has rebounded after such periods, making it beneficial to stay invested even during downturns. In summary, while never getting out of the market is generally solid advice for investors, there are some exceptions that should be taken into consideration. These include significant financial difficulties or scandals of individual companies, the need for cash, and regular portfolio assessments and rebalancing. By staying informed and understanding market trends, investors can better navigate market fluctuations and make wise investment decisions. How can investors follow this advice in practice? Following Peter Lynch's advice of never getting out of the market doesn't necessarily mean that investors should be blindly holding on to their investments even when the market is crashing. Instead, it means that investors should not be reactive to short-term market movements and should have a long-term investment horizon. Here are some practical ways for investors to follow this advice. 1. Stay invested. Investors should remain invested in the market to benefit from the compounding effect. Historical data has shown that over the long run, the stock market has provided higher returns than other investment vehicles like bonds and real estate. 2. Diversify your portfolio. One way to minimize the impact of short-term market volatility is by diversifying your portfolio. Investors should spread their investments across different sectors and industries, as well as invest in a mix of large and small-cap companies. This way, the impact of any one company or industry performing poorly will be lessened. 3. Don't try to time the market. Attempting to time the market by buying low and selling high is a strategy that has been proven to be ineffective. Investors should focus on the long-term trend of the market instead of trying to predict short-term fluctuations. 4. Have patience. Investing is a long-term game, and investors should be patient with their investments. Stocks tend to provide better returns over an extended period, and investors should have faith in their investments' long-term potential. What do you think of our video? Let me know in the comment section below. If you enjoy this video and want to hear from me again, be sure to hit that subscribe button before you go. Thanks for watching.